Hello and welcome to ACG Wealth Management's Monthly Investor Insights. I'm Bobby Moyer and I'm joined with my colleague Jimmy Pickert. March represents the end of a quarter, so our video may go a few minutes long, but we'll try to keep it quick. First, let's get into the numbers. The S&P 500 had a negative quarter, its first negative quarter in 2 years since the onset of the pandemic. The month was a little bit stronger, but really what was impressive was the return since March 14th, when the S&P 500 returned over 8% in that 2-week period. Jimmy, why don't you tell us a little bit about the sector performance for the month and quarter?
Thanks, Bobby. So during the month of March, utilities led the way, up 10.4%, with energy gaining 9% and real estate gaining 7.8%. With a few differences, it was by and large pretty similar to what we saw over the course of the entire first quarter. Energy was a stark outperformer, gaining 39% over the entire first 3 months of the year, and utilities gained 4.8%. So those two led and were in fact the only two sectors in the S&P 500 that were positive over the course of the quarter.
It was also interesting to see consumer discretionary and technology lead since March 14th, where we really saw that bounce back in the markets towards the end of the quarter.
Absolutely, and then if you look at mid, small cap, and international returns, they were doing better relative to the S&P 500 to start the quarter, but due to strong S&P 500 large cap performance during the month of March, they're now underperforming so far for the year. Mid caps have lost 4.9%, small caps have lost 7.5%. International developed markets lost 5.8%, while emerging markets, probably one of the tougher areas, lost 6.9% for the quarter.
Now we can transition a little bit and maybe take a look at interest rates and some bond returns.
Yeah, the other big story that we've seen so far, in the quarter and the month has been the pretty significant increase in interest rates and its impact on bonds, as well as what it may portend for the economy in general. The yield on the 10-year Treasury started the year at about 1.5%. It rose as high as 2.5% in March before finishing the first quarter at around 2.3%. And we also saw a pretty significant movement on other points of the yield curve too.
Yeah, exactly. We saw rates go higher, but what was also incredible was to see the short end of the curve, the 2-year yield and the 5-year yield move up to a level a little bit higher than the 10-year, starting to talk about an inverted yield curve, which we'll get into in a little bit. But why don't we touch on what that means for bond performance during the quarter?
Absolutely. So we've mentioned in the past that bond prices move inversely to interest rate movements. So as a result of that increase in interest rates, we saw a 2.8% loss for the main bond index, the Bloomberg aggregate, in the month of March, and a 5.9% decrease during the first quarter overall, which has been historically difficult.
Yeah, that's some historical numbers there. Those returns are some of the worst returns we've seen in any given month and any given quarter going back to 1980, the third worst quarterly return going back to 1980. So it was a pretty bad quarter for bond investors and month with these higher interest rates. So as we transition from some returns and talk a little bit about the Fed raised rates for the first time since 2018. They raised rates 25 basis points during the quarter. That was part of the influence on the short end of the curve we just referenced, but the markets are really pricing in somewhere between 7 and 8 rate hikes for this year, which seems like a lot for this rate hiking environment, but they're really trying to fight this inflation that's persisting through the economy right now.
Yeah, it has been remarkable to see how expectations for what the Fed is going to do this year have started the year pretty high, then they came down a little bit over the course of the quarter, and then really amped up pretty significantly through the month of March. And I think we should caution investors to recognize that while 7 to 8 hikes seems like a lot right now, it may not be the case that that's what we end up seeing. The Fed's, as they've always said, is data dependent. They're going to survey the scene and see what they need to do in order to make sure that they're doing what they can to control inflation without driving the economy into a difficult spot.
Yeah, and the economy is running hot. We've got low unemployment. We have the economy is growing. 11 million jobs are open out there. So when the Fed sits back and sees the consumer price index at 7.9 and a very strong economy, they should be raising rates, and if they see that begin to dwindle a little bit or slow, we could imagine that they would change course if they can as well. So something to keep an eye on. If they need to switch courses, they probably will.
Yeah. Connected with what we've been seeing from the Fed and the guidance that they've been putting out there is what we've seen, not just in the movement of interest rates, but the movement of the curve itself. And there's a common indicator that I think investors should realize we're going to see more and more of, and that's the 2 and 10-year spread. If you subtract the yield on a 2-year treasury from that of a 10-year, that spread has historically been a really good indicator of an upcoming recession. Whenever it hits 0, meaning the 2 years higher than the 10, recession tends to follow. Although the timeline is not the same every time. It could be anywhere from 1.5 to 2 years or even more from when we see that cross to when that recession actually begins. And we're filming today on April 1st, Friday, and as of this point, the 2 and 10-year spread has officially gone to 0. And so it'll be interesting to see if that historical indicator holds true this time or if this time is different.
Yeah, this just adds to a lot of the uncertainty that's going on in the markets, right? Are we looking at an inflation or a recession in late 2023, early 2024? That's still a long way off. A lot could happen in that period of time. The Fed, may have higher rates at that point in time. That if inflation begins to taper by the end of the year and into next year, and rates are higher, the Fed has more tools in their chest to combat a recession if we were to see that. But it's surely going to be talked about on the news. It's something to keep an eye on. But a recession typically doesn't happen for another, as you mentioned, 18 to 24 months, even 16 months after it inverts. So something interesting and keep an eye on.
Absolutely.
Jimmy, let's transition the conversation a little bit from things going on here in the U.S. to things maybe globally. We know there's a war in Russia and Ukraine that is terrible on a lot of fronts. We got a little bit of positive news towards the end of the quarter about peace talks being constructive between the two sides. What are your thoughts there?
The economic sanctions are definitely having an impact on Russia. It's really a question at this point of how long that can last, and it's encouraging to see these peace talks evolving over the course of the past couple of weeks. I don't want investors to be too optimistic. I think they have to recognize that whole conflict and the economic repercussions are going to continue to filter through the economy and the markets for some time to come, the positive recent developments notwithstanding.
Yeah, Russia's already been pretty much excluded or taken out of a lot of the world trade. Ukraine has a play in a lot of other commodities as well, the grain industry. And how long is all that going to take to build it back up from all the destruction and the people that have left the country over the last 6 weeks or so?
So as we conclude here, Bobby, I think that a key takeaway from the month of March and the first quarter in general is that it was a key lesson for investors of just staying the course. We preach this all the time, but it really bears repeating over and over again. Investor sentiment, as we pointed out in our last monthly video, was at close to historical lows. It was the lowest it had been since 2013. And we also pointed out in that video that that's a reliable contraindicator, meaning that when everyone's feeling really bad about being a stock investor, the subsequent period tends to be really good for stocks. And we saw that through most of the remainder of March as investors enjoyed a big rally.
Yeah, it's hard to tell what's going to happen next. That could have just been, an oversold market that caused the markets to react. But it all goes back to having a plan. And if you were invested in a way that was appropriate for your age, it was great. If you were an investor that is dollar cost averaging and investing in a 401k, you were buying things at a discount through all that. So stay to your plan. It's important to have a strategy that goes with your objectives, your time horizon, what's going on in your world, so you can stay put and stay invested in moments like this volatility during the first quarter.
Although we're still off from all-time highs, it's a decent time still for investors to take a look at their portfolio and consider how they felt over the past 3 months through all of that volatility, and really analyze whether or not the risk in their portfolio matches up with the risk tolerance that they can take, and make changes if they need to be taken. We have earnings season coming up. That's going to be a lot for the market to absorb and digest. it's usually a really good indicator of how publicly traded companies are doing. So that will be interesting to see, and investors have that to look forward to.
Yeah, so we'll keep an eye on the earnings, and we'll see you back here next month.